Welcome. My name's Timothy Clancy. I'm the Chief Muleteer. I've got Bonky behind me, and we're going to try the second episode of the live modeling. Hopefully the sound's coming through clear. First episode, my voice was trapped in a shoebox. Bonky did an extraction mission and was able to successfully retrieve my voice from the shoebox. So hopefully the volume's coming in better. I've got the mic set up. What these live modeling sessions are is really an opportunity to show sort of what I do in system dynamics and systems thinking. And even if you aren't involved in that, I'm going to try and pick topics and sort of combine, think about whose line is it anyway, improvisation, system dynamics, the science, and Bob Ross painting. So I'm going to be creating today a system structure model of the Silicon Valley Bank collapse. Now, this is unscripted, this is live, I have no idea how it's going to go, but if you do happen to drop by, leave a comment or a question here or over on the Facebook Info Mullet page. We'll see how it goes. It's going to be fun. So let's talk about the Silicon Valley Bank collapse. If you aren't familiar, last week, beginning on Wednesday, one of the major banks for the tech industry based out of Silicon Valley had kind of an odd announcement. They basically announced that they'd completed a sale of treasuries, but at a loss. So they took this large loss and they said they were acquiring funding to gain some cash reserves and selling shares, and that was Wednesday night. By Thursday morning, though, they hadn't completed the funding, and a giant bank run started. And the bank run actually withdrew $42 billion in one day. And in one day, Silicon Valley Bank went under. Friday morning, it was closed by the FDIC. It went into receivership. And it was this collapse that sparked this kind of recent bank run contagion. It wasn't the first bank to have a problem or financial institution last week. There was actually a crypto bank, Silvergate, that was involved in crypto trading. It actually closed operations and went into liquidation the day prior. So this was already set up in the air, but it was only the second major bank failing since 2009. Now, there's lots of bank failings coming out of the financial crisis, but no big ones. Silicon Valley Bank is 16th largest bank in the U.S. It had about $220 billion under assets. And its collapse sparked over the weekend this contagion of fear that has now reached not just the U.S. and Europe. So just to bring everyone up to date before we get started in with the modeling, on Saturday, the crypto stablecoin. So when the FDIC closed the bank on Friday, all the deposits, like, you put money in the bank, those were frozen. People couldn't get access to them. And part of Silicon Valley Bank is a lot of tech companies use it as a bank. So all their payroll was there, all their cash reserves. That seized up a lot of activities. And over the weekend, one of the Bitcoin stablecoins actually dropped beneath its peg because there was worries that its money wasn't going to be available. That actually recovered. But other groups like Etsy was not able to pay its vendors. So if you were buying and selling off of Etsy, money you gave to a crafter or something like that wasn't able to be returned. That was causing real problems for small businesses. By Sunday evening, there was a joint statement by the Treasury Department, the FDIC, and the Fed, where they came out jointly and said they were going to guarantee all deposits at Silicon Valley Bank. Now, this is unusual because normally the FDIC insures up to the first $250,000, which if you're, like those of us on this thing, more than enough. But if you're a tech company, $250,000 isn't much at all. So you may have millions or billions of dollars, and anything above that $250,000 is at risk. So they took the unusual step of guaranteeing those deposits. They went even further. They said they were invoking the extraordinary measures which were granted to them under past law to basically authorize this increase in the guarantee, and it wasn't going to be paid for by taxpayers. This was different. They said, if it requires us to gain more funds, we'll go ahead and get that from a levy of all the other banks. So we're kind of in uncharted water. In that same statement, the Fed said it was going to provide additional liquidity and funding for other banks, since a bunch of regional banks. And as we went over into the week, we're now here, it's Thursday, we've had several banks that are under pressure. Regional Bank, Charles Schwab, there's been some word about them. But also overseas, really big as this contagion spread from the U.S. overseas. Credit Suisse had major problems in the last couple of days, and really that's a large bank out of Sweden. It's had a history of scandal. It's been really problematic for a couple, probably 10 years now, but it's still a large institutional bank. and the central bank came out behind Credit Suisse. They just announced last night, it's called the financial bazooka. They were going to put a ton of money into Credit Suisse. So that stabilized a little bit. And it's fair that people are hearing all these terms like liquidity and solvency and bank run, and they're wondering, how does it all work? So today on the live modeling, what I want to do is create a system thinking structure using archetypes to demonstrate sort of the feedback effects that cause these bank runs. And we'll see how this goes. So let me check here, see if there's, make sure that I've got my streams up where I want them. There we go. All right, so let's go ahead and get started by sharing. I've got a blank canvas here. And this is Vensim, by the way. This is one of the many softwares I use. I use 3 different softwares for system dynamics. This is what I use kind of my workhorse for the lab to do it. And what we're going to be doing is systems thinking. One of the benefits of systems thinking is there's these existing system structure archetypes. So if you know the behavior you're trying to replicate, you may be able to pull a systems thinking archetype out and use that to replicate the behavior. Now I'm going to be leveraging that today because building these on the fly is not easy. What I'm hoping to do is not just talk about the collapse and the bank run itself, but what the origins of the collapse were in the back. So this is going to be fun, but let's go ahead and get started. First of all, I want to make sure, there we go. Let's make sure I've got a large font. I want to make sure I'm using Arial, right? We talked about this in the aesthetics, the other live episode. You want to use a clean font to read like Arial. You want it to be large enough size so it's easy to see. So we're going to do this. We're going to make sure our arrows, I haven't picked any yet. Okay, it won't let me pick. So generally, you know, some people do different approaches, and for those who are familiar with systems thinking, I'm not going to do the standard method or slicing a problem. I'm going to dive into modeling. Maybe on another live modeling session in the future, I'll talk a little bit more about that. But a lot of people start just by throwing variables. I tend to think that's kind of very tough. What I want to do is put a few variables down and get them in an archetype. And the first archetype I want to use is a very common one called limits to growth. This is where you have a positive feedback loop that can operate in a vicious or virtuous way, and it's got a negative feedback loop attached to it that controls it. And the key thing with this one is this gives us our core behavior of the bank run. This is going to be the archetype we use to demonstrate the bank run in action. So we want to start with cash reserves, right? So we'll have cash reserves. Over here we'll have withdrawals, okay? And down here we'll have perceived cash reserves. Let's see, let's first of all connect these. I'm going to do the positive feedback. So we need a positive feedback loop to get that. Think about $42 billion in one day. You're going to need a positive feedback loop to switch on that exponential growth. So withdrawals of, as withdrawals to cash reserves. So cash reserves, when we withdraw, it's going to decrease cash reserve. And as it decreases cash reserves, it's going to increase withdrawals. And as I'm doing this live, there may be changes. Like I said, I have no idea how this is going to go. Let's make these a little bit larger in size. And there may be changes. So let's think about this. No, I don't. Withdrawals and cash reserves. So as I withdraw, the more I withdraw, the less cash reserves I have. The more, again, when you're doing systems thinking, you want to walk through. The more cash reserves I have, the more I withdraw. That doesn't make sense. So let's think about how we're doing this. We got over here, we need to have confidence. We need to have deposits. These are some things we're going to be incorporating here. So as withdrawals increase, cash reserves decrease. As cash reserves decrease, right? And remember that the use of the positive and negative isn't necessarily saying that if it's positive, it's always going up. What positive means is that the direction of the antecedent effect is the same as the direction of the movement of the precedent effect. So when we see a negative sign here, what we're saying is as withdrawals go up, cash reserves go down. It's in opposite directions. A positive polarity means it's in the same. So as cash reserves go down, confidence goes down. So that's a positive. And as confidence goes down, withdrawals go up. Okay, there we go. That makes more sense. So what we've got here now is we've got our first positive feedback loop, and we know it's a positive feedback loop because it has two negative polarities. Again, you can think about it if you want to walk through this. A positive feedback loop is sort of compounding behavior. It means if you create a change in there, it's just going to take that change in the direction it was going. So think about this as a system where we start with a withdrawal, and it reduces the cash reserve. That's this link here. So withdrawals of cash reserves. Now, if that was the end of it, that'd be fine. But the cash reserves, as more gets withdrawn, the confidence goes down. So cash reserves have gone down, confidence has gone down. As confidence goes down, withdrawals go up. As withdrawals go up, cash reserves go down. So even though we have these negatives in here, because we have an even number of negatives, it's actually a positive feedback loop. So we're going to mark this here, comment, I'll just call this the bank run. And again, I'm throwing these down there just to get something out. I might change these later. We want to do positive sign. We want a circle that is going to be clockwise. Oop. That didn't look right. There we go. Why is it? Oh, I think I've got the color on this wrong. Remove from this view. This is why it's live, right? Here we go. Color blue. Clockwise. Why is it not showing the arrow? I've got this new interface here where it's not playing nice. What I want is I want to see the arrows around it to show the direction. We'll figure it out. So normally this would show an arrow around it, showing in a clockwise. It would show the direction of the feedback loop and which way it's going. So let's go ahead, and now we've got this. Yeah, it's weird that they're doing that. Not sure if this is something I'm missing here. Comment, navigate view, use arrows junction, hide level none. Well, we'll make sure we'll get it added here in a second. So if you think about this as a positive feedback loop, one of the challenges of positive feedback loop is it's going to run in that direction no matter what, right? It's going to continue to run without interruption. And that's kind of unrealistic. There's this thing called, you can't grow something forever. There has to be a limits to growth. And in systems thinking, our positive feedback loops, they run in virtuous or vicious. So think about this. If we had an increase in cash reserves, right? An increase in cash reserves, right? Say we had something coming here like a deposit, right? It would increase cash reserves. This would increase confidence. It would decrease withdrawals. And that would result in an increase of cash reserves along the deposits are coming in. So you need to have, so that would be virtuous, right? That we wouldn't have a bank run. So you need something that can switch a positive feedback loop from virtuous to vicious behavior. And the way I've modeled this, it's currently in vicious. But the way that the positive feedback loop switch is a negative feedback loop. There's some negative feedback loop that it hits an amount. So the negative feedback loop here is the, let's see, as cash reserves go down, liquidity, somewhere out here is the FDIC intervention, because they're going to be the ones who stop this. Well, first of all, we could flip it with deposits, but deposits weren't happening. So as cash reserves, let's think through this here. It's not solvency, it's really liquidity. This is a liquidity. Let's label this one liquidity. Or bank run. So this is really a liquidity problem, and as cash reserves decline, the cash infusion? No, it's not. It's see, the reason I'm struggling is normally we'd say something like you know, there'd be some sort of cash infusion that would put these reserves enough to restore confidence. But what happened is the FDIC, I want to say it's liquidity concerns. So as cash reserves declined, liquidity concerns raised, so that's going to be a negative, right? And there, and as liquidity concerns raise, it doesn't result immediately. It's not that liquidity concerns lead to more cash reserves. They lead to liquidity reserves lead to an FDIC intervention, which the FDIC intervention reduces the withdrawals. So this is the bank closure on Friday, right? As the liquidity concerns rise, the bank, as liquidity concerns, so as cash reserves decline, liquidity reserve concerns rise. As liquidity concerns rise, FDIC intervention rises. There we go. And this is actually, so this now is the stopping action on Friday. Let's go ahead and get some of these. Change that to get a good size to it. By the way, welcome everyone who's coming in. I'm basically modeling the Silicon Valley Bank collapse, doing it live, which is not easy. This is a test to see. I did aesthetics over the weekend. Now I'm trying to model live, and this is not an easy thing. So we'll see how it goes. We'll just play around with it for a bit. I see someone on the Facebook. I had a vision of we're the live modeling, to be clear. If you're here for like an OnlyFans live modeling, this is probably really disappointing right now, although with the way these loops go, maybe we'll get something saucy that way. But no, this is a feedback structure. So the cash reserves, I want to make sure. So one of the ways that I'm thinking that like deposits, as I put deposits in, right, cash reserves go up. And as cash reserves go up, that's going to trigger. So that's what there is. There's really two federal IDC interventions. There's FDIC bank closure. There we go. And there's also the Fed liquidity injection. So these were the loans that were offered by the Fed on Sunday night. Let's just say access Fed loans. So as liquidity concerns rise, they access Fed loans. Your propensity, this is really shouldn't be accessed. When you're doing these systems thinking, you want your phenomenon terms to be capable of rising and falling. So you need to phrase them in a way where it can have both kinds of behavior. So access to Fed loans isn't that really that good. It's more like propensity to take Fed loans, right? So as cash reserves decline, because we have withdrawals, as withdrawals increase, cash reserves decrease. As cash reserves decrease, liquidity concerns increase. As liquidity concerns increase, the propensity to take Fed loans increase. Fine, I'll save it there. So we'll just do CLD, live modeling, SVB collapse. There we go. All right, so as propensity to take loans increases, that will increase your Fed loans, which will increase your cash reserves, right? Now the trick is, so this is good. This is getting us where we want to go. And it's a little bit tricky right now because we're dealing with something that wasn't actually an option for Silicon Valley Bank. They did not get access to the Fed loans. This is a counterclockwise. Maybe that's it. Nope. Interesting. Yeah, I'm really not sure why it's being tricky on the Fed injection. why it's being tricky on getting. So normally, as you saw in the aesthetics, you'd have a feedback loop thing that would show that this is, for example, running counterclockwise. So here's this. All right, now this is probably going to change, but it at least gets us started. So we have a basic function here, which is, we need to get this, is as propensity to take phone loans increases, Fed loans increase. As Fed loans increase, cash reserves increase. There we go. Make sure, mark this, check the stream. Again, if you're just showing up, drop a comment, say hello, and feel free to ask any questions. So we've now got the basic, oops, this should be a negative, because it's got, remember, when we're counting our, it's really being tricky here. When we're counting whether it's a positive or negative feedback loop, we count the negatives polarities. That's what these little ones are here. These are negative polarities or positive polarity. We count them in the loop. If they're an odd number, it's a negative polarity loop. If they're an even number, it's positive or no negative. So you see over here, there's two positives, or two negatives. That creates a positive feedback loop. That's why I've got this marking here. This one, however, is a negative feedback loop. So counterclockwise. Really not sure why it's not adding the arrow, but I'm sure there's something they changed that makes this. Huh. Oh, I'll get that fixed eventually. So this gives us our positive and negative. This is our limits to growth. This structure right here is our limits to growth. It is this structure that's going to do it. Now the question is, which comes first? The Fed intervention that allows you to take loans, or the FDIC bank closure? So this is where we're going to get into something called solvency. Now, negative feedback loops have a goal. They're called goal seeking. If you think about this, or excuse me, it shouldn't be solvent, it should be liquidity, perceived. Let's see, actual liquidity. So this is, I want to be careful here because in bank terms, liquidity and solvency sound similar, but they're actually different things. So perceived liquidity. So the actual liquidity, so think about liquidity. If you're a bank, especially in a fractional banking system, let's say you have $100 billion, right? Or let's make it simple numbers. You have, let's say $100 billion is deposited with you, right? You're going to go out and invest that in something else, and then you're going to do all these loans and things like that. You may only have $10 billion in cash on hand. This cash reserve, this may only be $10 billion. So if you have $100 billion of deposits, and there's only 10 billion of cash on hand, that may be good for every day, but if all of a sudden everyone starts withdrawing, you don't have enough money. Liquidity is when you don't have enough money to pay out your normal operating, your withdrawals, your bills, your things like, your customers asking for their money on their deposits. Solvency has to do with whether your overall assets are worth more than what your debts are. And we'll get into that in a second, but the perceived liquidity here is driven by confidence, right? And as confidence goes down, perceived liquidity goes down. So that is a positive relationship there. We'll put deposits here. As perceived liquidity, think of this now as the market's perception. Actual liquidity is what's ever inside. The bank knows that, but if you're outside, you're a tech company or you're a VC, it's Thursday morning, you just saw them announce a loss and needing to raise additional funds and they had to do it. The perceived liquidity is this perception of risk, how much you're going to do. So this actually, as the perceived liquidity increases, it actually increases the likelihood of an FDIC intervention. As the perceived liquidity risk, right? So this is going to, and what this does is this sort of does a threshold liquidity threshold. As you reach that, so this, being careful here. I'm not really making, I want to be careful here of how I make this, but let's remove this. This is actually, let's take this. We're going to change this now up to, this will be what causes the FDIC actual liquidity to go into perceived liquidity, and we'll delete that. Remove. So now we've got, here we go, as perceived liquidity risk increases, FDIC, we'll say this propensity this is why we call it live, right? So this is going on outside. Make this, that's a positive, that's a positive. Okay, we'll make these thing. And the actual liquidity is contributing to the perceived liquidity, along with the confidence. Now, let's take a step back and try and get some, I'm not saying this is 100% right, but it's a start. And that's the thing with systems thinking. It's going to be an iterative process for this. We talked about solvency and liquidity. Like, how did Silicon Valley Bank get into this, right? So let's take a step back to 2020, right? Let's label this. This is bank run March 2023. All right, there we go. So let's actually now move all this. All right, we're going to move this to the side and say what happened in 2020 that led to this situation. So there's in 2020, obviously the pandemic, right? That's what happened. And during the pandemic, tech stocks boomed. And so there was a lot of money raised for new tech companies. Silicon Valley Bank is, the chief beneficiary of this. So they have pandemic era, let's see, I want to call them tech startup funds, right? So these are technically deposits, right? So you're a bank, and we're gonna start that over there. We're gonna say this is back in March to call it December, or let's just say 2020 to 2021. So during this time, they're getting all these pandemic era tech startups, right? Let's see here. They're going to get, this money is coming in from fundraising that basically, it's not an IPO, right? So basically venture capitalists are going out to their investors, they're generating money, they're getting money for these tech startups, and they're having the tech startup put it in the bank. So say you're a new tech startup, you get $1 billion of funding, or 100 million more likely, or even 2 million, whatever the number is. You're going to put it in the bank. The reason you put it in the bank is that that's supposed to fund your operation cash flow for so much runway until you hit that next fundraising target, round 2, round 3, or you get to do your IPO and you sell and everyone makes a bunch of money. So the what the question is that Silicon Valley Bank has to face is it's got to do something with this money that it can generate enough income to pay out those operational withdrawals without necessarily in the future. And you have a choice of strategies here. You're going to have several different strategies that you can pick from. And let's see here. I want to find... Let's see. So when you think about strategies and system dynamics, you want to think about choosing between multiple strategies. It's something called the attractiveness principle. And the attractiveness principle is kind of this concept where you have two options, and we'll simplify it to two. One of them is by doing one, you're sort of reducing your ability to do the other, or one is more attractive, so you're going to do that more than the other. What this means, though, is in this case, what I want to do is show how by doing one thing, they actually reduce the ability to do another. So let's open it up, and I got some examples of archetypes over here I'm going to look at just to make sure that I'm doing this right. And the attractiveness principle is, that's excellent. All right, so it's got the results. So this is really where we're coming in. What the attractiveness principle is, right? You have here allocation of funds, or that may be the effort. And then over here, you have the risk of allocation. That may be right. So down here, we're going to have invest in T-bills. And we're going to simplify this by, say, invest in loans. As we invest in T-bills, we risk allocation. Let's see. I'm trying to see here. As we get, what I'm trying to do is demonstrate. So basically, what happened is they got 100 billion in pandemic era deposits. They had a choice. They can invest this. They can loan it out. A bank, they can do loans. They can put it in securities or some sort of trading vehicle. What they chose to do, however, was buy treasury bills. And by choosing to buy treasury bills, they kind of created the conditions which bid them now. When it comes to treasury bills, one of the things that's important is there's a face value and a market value. And when you buy a treasury bill, it's got a long-term duration, say 10 years, it's got a fixed interest rate, and it's got a face value. So if you buy a treasury bill, let's say $10,000 or $100,000 a treasury bill, in 10 years, the government's going to give you that money back. Guaranteed. U.S. government, very safe bet. And it also has an interest rate on it. That interest rate is kind of what they pay you to have that money. So if you think about it, if I spend $10,000, let's say $100,000, I buy $100,000 of treasury bills in 2020, in 2030, I'm going to get $100,000 back. Now the reason I might do that is, where's the gain, right? It's the interest rate or the coupon rate of that treasury bill. So say that coupon rate is 10%, right? I put in $100,000 over the course, I'll get $10,000. That's the money I can use as a bank to pay out the withdrawals. If I get $100 billion of incoming funds from pandemic era funds from these tech startups, Silicon Valley Bank, I can buy $100 billion of treasury, and I know in 10 years I'm going to get those $100 billion back. In the meantime, I'm getting interest paid to me by the government. And the trick here is the interest is kind of a reflection of current economic, but also future expectations of where we think things are going to be. Because if you think about it, $1 today is going to be worth more than $1 10 years from now. So you want to account for the fact that you can't use your money and that inflation, it's going to be worth less. So all of these numbers go into an interest rate. And the interest rate on the treasury bill determines its value. So let's just we're going to do a quick seminar on treasury bills, right? The interest rate determines its value. And what I mean by that is if I have a treasury bill that's got a face value of $10,000 and a fixed duration, I'm going to get those $10,000 back, and every period I'll get my 5% interest over the course of the loan. So that has a $10,000 face value. But if I compare that to another $10,000 treasury bill that has a 10% interest, right? Their face value of both is $10,000. But the market value, if I'm going to spend $10,000, why would I spend it on the one where I'm only getting 5% interest instead of 10% interest? I'm going to spend it on the one that gives me more money back for the same amount of investment. So the market price of the treasury bill is different than the face value of the treasury bill. And the face value is determined by whatever you bought it at. The market changes every day. And back in 2020, if you remember, the Fed interest rate was effectively zero or very close to it. The government was just pumping money in through every single way to kind of spur economic investment in the face of the pandemic. Money was cheap. Money was easy. That's one reason fundraisers were able to generate so much funding for the tech startups is because money was, it didn't cost much to borrow money. If you think about the Fed interest rate, that sets the floor for all other interest rates ahead. Now, maybe as a bank, I want to actually loan my money out to other commercial interests. I can do that, right? So instead of if I have $100 billion, I've got to choose how much I'm going to loan at. The trick with a loan to anyone else but the US government is there's always a risk that they're not going to pay it back, which means that now I may get a higher interest rate, but there's that safety question. Where am I going to put my money to ensure I have it, and am I willing to take the risk? Now, if I have $100 billion, I could loan it out to a variety of different risk levels, but some of those loans are going to fail, and that means I'm not going to have $100 billion down the road. I'm going to lose that. My assets will go down. So let's start putting in some of these values and terms for assets, market price, coupon rate, and I'm going to go back to, we're modeling here, right? So one of the key things with bonds is Fed interest rate, right? So if you think about that relationship I mentioned, right? As the Fed interest rate, if I have two bonds and one has a higher interest, I'm going to value that bond higher than the other. So there's this effect where the interest rate, the bond yield, think of that as like price, the bond yield goes in opposite to the Fed interest rate. As the Fed interest rate goes up, the market price of a treasury bill goes down. So this is going to be a negative, right? Negative feedback, a negative polarity, right? And the face value is not going to change. It's going to stay the same. Now, if I hold a T-bill to its maturity, I get the face value. I don't have to worry about it. I'm going to get that guaranteed money. But the coupon rate determines my cash flow. So interest payments, T-bills. So as the coupon rate goes up, here we go, my interest payments go up. As the Fed interest rate goes up, and it's not exactly like when you're buying a T-bill, you're not really buying it from the Fed, you're buying it from the US government. And so it's not exactly the same that the Fed interest rate is a lock on the Treasury. The Treasury bill is whatever people pay for it. They're going to buy, the government needs to sell a lot of debt, people are going to bid and auction on it, but it goes kind of. So as the Fed interest rate goes up, the coupon rate goes up of the next bill. So these are coupon rates of new coupon rates. So market price of, let's say, pandemic T-bill. I'm going to, because we're buying T-bills at times, so I'm going to distinguish the pandemic from later ones. So and because we were in a recession, or we were fearful of recession, the coupon rate of pandemic or coupon rate pandemic T-bill was low. And here's the thing, as the coupon rate, so this is really change in coupon rate, right? As the change in coupon rate, let's just call this change in, right? As change in coupon rate goes up, interest in payment from T-bills goes up. But that's from new T-bills, right? Right. As the coupon rate of pandemic T-bills, this is the interest payment. Pandemic T-bill, right? So here's the way this all goes into place. The interest payment on the pandemic T-bills actually adds to your cash reserves, right? This is money you get coming in. The market price of the pandemic T-bill adds to your assets. And this is going to get messy for a little bit here while I try and map this out, right? So the market price of volume of T-bills purchased, face value price, and this is going to be face value assets, and market value. Okay, so we've got a couple things going on here. As the market price of the pandemic T-bill, the face value price determines the volume of purchase. This is your book value here, right? The more T-bills you buy, and I promise we're getting somewhere here, the more T-bills you buy, the more the face value of your assets. The trick is the market price of the T-bill. As market price goes up or down, market value of assets goes up or down as well. Now, this gets into the accounting issue where difference between face and market value. This is getting into where the, let's put these down here, get these, focus on this area here. And this is definitely a fun challenge for me modeling this, because this is not an area I normally work in. So it's definitely, it seems simple until you start doing this live. Let's see if I got any questions going on. Looks good. All right. Yeah. All right. So the difference between face and market value, as market value assets change, right? That difference is going to rise. And this gets important for understanding Silicon Valley Bank, because it's your if you think about it, they bought, say they bought 100 billion, this face value assets, they bought 100 billion in T-bills back in the pandemic, right? And it was at a very low interest rate. The coupon rate of the pandemic T-bill determines the interest payment from pandemic T-bills, which is over here. So this is your volume of T-bills. So these are pandemic T-bills, right? So they buy 100 billion T-bill, and I'm just throwing a number out. That's not the exact number, but actually closer to 4 billion, I think, was the total amount. But the problem is the interest rate that they're getting on those pandemic T-bills is very, very low. Because remember, at the time, the recession, the threat of recession, was reducing the Fed interest rate. So as risk of perception of recession, as that increases, that will decrease the Fed interest rate, which then influences the cost for U.S. government to borrow money, and that influences, so the Fed interest rate directly influences the cost of the U.S. government to borrow money, and as the cost, there we go. Now we're starting to cook. So as the recession, or the fears of recession, increase, the Fed interest rate decreases. The Fed interest rate decreases, and this is back in pandemic times, right? Cost to borrow, cost for U.S. government to borrow money. As the Fed interest rate increases, that increases. As that increases, that goes to coupon. But the perception is that this is, so wait a minute, perception of recession is actually going, as perception increases, it's going to, decrease. So the decreased Fed interest rate led to the cost to borrow money to decrease, and that led to a coupon rate T-bill. That carries through. Now these ones here, we're going to add some time delays here, because these are now, what we're doing is we're distinguishing between what happened at delay mark. So when you see these little hashes, that means there's a time delay. Right. And we might not need the new T-bills. Anyway, so the interest payment to this comes into your cash reserves. And I'm not liking how this is starting to get, so I'm going to put this down here and change this. I don't like, remember in the aesthetics, I don't like having overlapping lines. It gets confusing. So wherever possible, as you're going through, working through this, take out your lines. There we go. All right, so you've got a coupon rate, and let's start changing these. I want to get some different colors in here. So we're going to call these red because this is what blew everything up. So we're going to change all these colors to red. And that will allow us to... There we go. By the way, as the Fed interest rate lowers, economic growth increases. I'm going to do a little, we don't want this hanging out exogenously, so we're going to go ahead and combine that into a feedback loop here. And the reason economic growth happens is because it's easy to borrow money, right? It's cheap. All these tech companies were started during the easy money times of the Fed. So as the Fed interest rate decreases, economic growth increases. That's an opposite. And as economic growth increases, perception of recession fears decrease. So now we have a nice little negative feedback loop here. Try and get it a little bit more circular so it doesn't look so jangy. There we go. And we'll put here why did it not? Image counterclockwise. All right, so this is the, let's change that color. Negative feedback loop. All right, so this negative feedback loop here is what, think about it this way, at some point the Fed's, the recession fears are going to pass, right? So what happens here, and we'll do this again, this is over time. This describes what happened in the markets from the pandemic. So we're going to say this is return to normal economic growth, right? And this also has a delay mark, right? As the cost for U.S. government to borrow money goes down, U.S. government spending goes up. These are some key dynamics here. As U.S. government spending goes up, inflation goes up. Right? As inflation goes up, the Fed interest rate goes up because one of the Fed's mandate is to fight inflation. They have what's called a dual mandate. That means their mandates are to it's interesting that I'm looking at the video of myself live here, and it's only showing a few of the dynamic models. So I'm wondering, I'm hoping it's keeping track of this. So as inflation goes up, Fed interest rate goes up, and what we'll do is basically do this as a circle around. As inflation goes up, Fed interest rate goes up. As government spending goes up, right? And this is what caught the Silicon Valley Bank here in the pickle. What happened is, put all these to red. All right, so now what we have here is the, also as the perception of recession decreases, inflation also goes up. No, I don't want to do that. Return to economic growth, that was what it was. There we go. Plus. Make these all red. Let's make the lines thicker too. Pick a different color for that. A little purple. All right, so now make these line's actually a little thicker, so it's easier to see. Basically, if you think about red is what caught, is going to be what catches Silicon Valley Bank, because we're moving forward in time now. We're moving forward from the pandemic area to the return to normal to now. And you know, we went through the period where inflation was very high, still in a period where inflation was very high. So you can kind of begin to see this. So the volume of T-bills, coupon rate, pandemic era text funds. So this is this goes here. They've got this cost for U.S. government. So as Fed interest rate goes down, pandemic era tech funds go up. All right. So what happens here, that's going to be opposite. So what's going on is that let's go back to that $100 billion, right? As the Fed interest rate goes down, pandemic era tech funds go up, startup tech funds go up. They use that to buy, let's move all of these. We can see the great thing with this is you can kind of give yourself more room, just adjust it on the fly. Let's do this. The volume of T-bills goes up as they purchase it, because this is what Silicon Valley Bank did. So now they've got this sort of situation that's unfolding here, is where they've bought $100 billion in T-bills, let's say, right? This volume is because they had all this money. 100 billion came in from the investors. They put 100 billion in T-bills, right? The interest payment from the T-bills is going to be low. Remember, it says it's going to be a low interest payment. So the amount they have coming in over time to the cash reserves is also going to be low. Now we're putting it as a positive mark because as you get money from interest payments, that goes into cash reserve. So cash reserve goes up with interest payment. But what you're beginning to see emerge here is a disconnect between the amount of money that they need and what they're getting for their interest payments. Because if you think about that $100 billion, companies are going to need access to that pretty frequently and pretty regularly. They're going to want to pay their pay bills, their payroll. They're going to want to buy technology. They're going to do marketing, advertising. They got a burn rate. So every startup company has a burn rate. And as they're burning through that, they're pulling out of the cash reserves. Now remember, they put in $100 billion, but Silicon Valley Bank went and bought $100 billion. And I'm using round numbers here. It's not $100 billion. It's actually closer to $4 billion. So let's use the number that Silicon Valley Bank that we know it was about. They put in however much money they put in for the investors, let's say is $100 billion. And with that, they bought several billions worth of treasury bills. So now there's not enough money in the bank to pay back everyone. If they withdrew everything at once, the bank wouldn't have enough. That's fractional reserve banking, right? Silicon Valley Bank believed that these interest payments were going to give them enough cash reserves such that when withdrawals came, they had enough money to give. But what happened is, first of all, the tech companies that we had this recessionary problem with the inflation, the tech companies were going longer, and the new companies weren't coming in as frequently as Silicon Valley Bank anticipated. So let me see here. Well, I hope this is showing up on the thing because it's showing on my OBS, but YouTube isn't showing it up. So we'll hope this comes through. We'll see how it looks. If not, I can do the whole thing again. So the amount of money coming in from the interest payment from the pandemic T-bill is not enough to meet the outflow of the cash reserves. And what happens then is Moody's and I'm reaching the top of the hour here that I gave for this, so we'll probably stop it here and pick this up again. But Moody's approaches them about 2 weeks ago. So all of this is happening. Everything that's in this red happened in the past, right? Let's actually get these. Let's get these as green. Because this is what happens Here we go. Little green, happy green. And let's get the lines a little bit thicker. All right. So I'm going to delete some of these extra ones that aren't needed anymore. Let's not talk about, we don't need to worry about new T-bills because that's not really a problem here. All right, so the face value price. So Silicon Valley Bank has these bonds on their book, $4 billion or whatever it was, that they bought it at. That's the face value, right? They're getting interest payment on them based on the volume they purchased, but it's not meeting the obligations. So they're having a cash where more cash is going out than is coming in. 2 weeks ago, Moody approaches them and says, hey, we noticed that you've got this problem. We're going to downgrade you by 2 notches, right? Now, that's a big deal for a bank to get downgraded by Moody's. And thank God Moody's actually downgrading anyone. One of the big problems with the financial crisis in 2009 is Standard & Poor's, Moody's, all these companies, they refused to downgrade anyone. They were just, The Big Short, you can watch that movie. They talk about how the ratings agencies weren't credibly rating risk. Well, Moody's was on top of this one. They came to SVB about 2 weeks ago and said, we noticed you have weakness in your book and that more money's coming out than's coming in. Silicon Valley Bank says, hey, I have $4 billion in treasury bills. I'm going to sell that and raise money to fill the gap in my portfolio. The problem is between when they bought that, remember, pandemic T-bills were at the lowest interest rate, and the interest rate goes opposite to the as interests go up, your previous T-bill's price goes down. So the Fed interest rate, as the Fed interest rate went up, and it's gone up a lot. It's been raised, I think it's something like 17-fold from where it was at the time they got this. So the market price of your pandemic T-bills has gone down. That because no one wants to buy, let's say it was 1%. Your pandemic T-bills are paying 1% interest, 2% interest, something low, right? I can go out and get a T-bill today, and it's paying multiple times that, right? So why would I pay more anything? I need a discount. I'm not going to buy your treasury bill, Silicon Valley Bank, at the face value they're issued for. So of the $3 billion or $2 billion or whatever it was dollars that Silicon Valley Bank was, when they sold it to raise money, they had to sell it at this difference between face and market value. They actually lost $500 million. And that $500 million was that was the amount they were trying to fill. So Moody's said, if you can sell this, we'll only downgrade you by 1 notch. So if you think about over the 2 weeks they were getting ready, they did this sale in the treasuries. Wednesday of last week, they sold the treasuries. They took a $500 million loss. That's the difference here between the face value and the market value. So the difference was $500 million. Now, they tried to sell that, and I'm not going to get into modeling this because I only want to give myself an hour. But basically, to finish the story, they tried to sell shares of the bank to raise the $500 million, and they wanted to do it by Wednesday night, Thursday morning, because they thought if we can get this done before the bank opens, then the story is going to be we sold bonds at a loss, but we covered that loss with additional fundraising. The problem is they weren't able to complete the sale. They had a couple buyers who were looking. They weren't able to do the due diligence fast enough. The market and the banks opened Thursday morning with the word that losses, right? Losses with uncertainty, right? So this is the last connection I'll make here. So when you have losses with uncertainty, this is Thursday morning. I'm going to say this is Thursday morning. So we've gone from back here, we're in the pandemic time, we're moving forward. This is Thursday morning of last week. The news is we sold at a loss and no one's backing up that difference. So what happens? Your confidence goes down, right? As your confidence decreases, so as the difference between the face value and market goes up, your losses with uncertainty goes up, and your market, I just want to finish this here. All right, make this black. All right. And so as Face value, market value, they go to sell. The difference between the face and the market value you get as losses with uncertainty Thursday morning. As losses with uncertainty Thursday morning increase, confidence decreases. It's a negative feedback. Now, we're now back over here into this structure. We've attached what happened back in the pandemic times with our modern structure. As confidence goes down, withdrawals go up. As withdrawals go up, cash reserves goes down. As cash reserves go down, confidence goes down, withdrawals go up. This feedback loop kicked off Monday morning and by mid-Thursday had taken out $42 billion with a B. Now, this is the problem when you have a lot of tech startup and VC clients. Most of them, and I can model this in another episode if we get to it, most of them are way above that 250,000 FDIC cap. So they're panicking because they need to get the money out. And it's a small community. Word travels fast. They all know each other. So this positive feedback loop begins churning $42 billion. And very quickly, there becomes a concern that their actual liquidity, and remember, these weren't even available. The Fed loans, they weren't available yet to do the normal switch off. So their perceived liquidity risks increases. It jacks up until the propensity of the FDIC to close the bank. They take a look at it Thursday afternoon, Friday morning. They do not like what they see, and they close the bank. And so we should actually, you can kind of imagine what happens here. Close the bank, right? As the propensity of the FDIC to close the bank goes up, the bank is closed, and the withdrawals stop. All right, and that's this one here. So we've now completed our loop. It's a little bit hairier than I was hoping. This is obviously not a topic I'm as familiar with as violence as instability, but I'm hoping to show here some of the dynamic, and there's a lot of other things going on. Like I could come back and finish this model out, but what we've got now is a basic model that replicates. You have pandemic, perception of recession, Fed rates go down, pandemic or tech startup funds go up, cost for U.S. government borrow money goes down. That means the coupon rate of the T-bill that you invested in with all that investor bro money, that tech bro money, you're buying a lot, but the interest coming off it's not high. Even though you've got a decent face value that's going to be safe 10 years out, what you need is interest payments to match the cash reserves as the withdrawals come out. You go forward 2 years from the end of the pandemic, Moody approaches you, says, hey, we see you're not doing great, you're going to need to sell some. The difference between the face value and the market value of your T-bills is because the Fed interest rate in the meantime has gone up, and so the market price of the pandemic T-bills has gone down. The difference there is your losses with uncertainty. We're now moving up to Wednesday, Thursday morning. Press release comes out, confidence drops, withdrawals start. This positive feedback loop kicks off. $42 billion withdrawn. Actual liquidity is perceived to be bad. Perceived liquidity risk goes up. Propensity to close the bank increases. Closing the bank increases, and that stops the withdrawal. Whew. We've made it to Friday morning. We are now at mid-morning Friday. So this is what live modeling is like. Like this is a little bit more stressful for me because I'm trying to think about what I'm doing as I'm explaining this. This certainly isn't the aesthetic quality I would normally want, but this is what modeling begins to look like. We got a couple of archetypes in here we can talk about. We might clean this up, but I might do that in another modeling session. So again, I wouldn't turn this in as a final product, but it gets us started. We have something on paper. It's been an hour. We have the general dynamics of the collapse from its beginning to its end mapped out. There's a lot of other things we get into, solvency, asset prices, the contagion and systemic risk. Might do that again. Hopefully you've enjoyed it. Drop a comment. If you want to see a phenomenon like this, doesn't have to be finance. Actually, please don't make it finance. Obviously, I struggle with finance. But if you want to understand something to do with violence and instability, which is what I focus on, something to do with warfare, or just some phenomena that's in the culture or the news, drop a comment below or drop it over on our Facebook, and we can do these sessions again. Hope you enjoyed it. Have a great day.